Hello and welcome to Lecture 3 in this lecture series on the subject of Principles of Insurance IC01. This lecture series is based on the syllabus fixed by the Insurance Institute of India in 2025 and is designed to help those students who would like to watch and listen to lectures to understand the subject and write the exam conducted by the Insurance Institute of India. This lecture continues to deal with Chapter 1 and will cover the topic Ingredients of Insurance. But before that, let us have a recap of Lecture 2. Explore risk management, a cornerstone of insurance. We discussed how risks are identified, treated and managed. Remember the three key strategies: risk avoidance, risk transfer and risk retention. In risk avoidance, it is steering clear of activities that expose us to risk. Risk transfer is passing the risk to another party, often through insurance. And risk retention is accepting the risk and preparing to deal with its consequences. For those interested in watching Lecture 2, we have posted the link to it in the description to this video. Now, these concepts set the stage for today's discussion. Insurance is a formal tool for loss mitigation. Today, we'll look at how insurance fits into the broader framework of loss mitigation. We'll explore its principles, ingredients, and legal foundations. First, we'll deal with loss mitigation. Let us begin with a simple question. How do societies traditionally deal with loss? In many communities, informal mechanisms exist. For example, in villages, we see people pool contributions to support a family that's lost its breadwinner. Donations pour in during natural disasters like floods and earthquakes. These are voluntary and informal methods. While noble, they have limitations. They are unorganized. From the victim's perspective, they are unreliable. In large-scale distress, the suffering is widespread and help may not reach everyone. That is where insurance steps in. A formal, organized and reliable mechanism for risk sharing among those exposed to similar risks. So, what is insurance? Let's break it down. At its core, insurance is a contract. It involves a premium, the consideration, a promise by the insurer to make good the loss suffered by the insured, and the loss must arise from an insured peril. Let's understand this through the lens of contract law. According to the Indian Contract Act 1872, an agreement enforceable by law is a contract. Insurance contract, therefore, is a legally enforceable agreement between the insurer and the insured or the customer. The next ingredient is consideration. The Indian Contract Act defines consideration in a lengthy manner. It says, when at the desire of the promiser, the promisee or any other person has done or abstained from doing or does or abstains from doing or promises to do or to abstain from doing something, such act or abstinence or promise is called a consideration for the promise. In simple terms, consideration is something done or promised in return for a promise. In simple terms, consideration is something done or promised in return for a promise. Just like A sells a house to B for a price. Here, the consideration for A is the price and the consideration for B is the house. In insurance, the insured pays a premium, which is the consideration for the insurer, and the insurer promises to compensate for losses, which is the consideration for the insured. Let's look at the essential elements that make insurance work. Insurance is a promise to make good the loss. Insurance does not prevent loss, it indemnifies. Indemnity means restoring the insured to the financial position it was in before the loss. Contract Act defines a contract of indemnity as a contract by which one party promises to save the other from loss caused to him by the conduct of the promisor himself or by the conduct of any other person. So, loss must be suffered by the insured. If there is no loss, there is no indemnification. The insured must have an insurable interest. You can't insure someone's property unless the loss affects you directly. You can't insure someone's property unless the loss affects you directly. This is a general principle. An exception to this is life insurance, where insured is a person and the loss cost is to the family members of the insured on the death of the insured. The loss must arise from an insured peril. Not all losses are covered. Insurance policy clearly lists exclusions. What's not covered? Only losses from insured perils are eligible for compensation. So, to conclude, insurance is more than just a financial product. It's a society's safety net, a legal contract, and a risk sharing mechanism. Understanding its principles help us appreciate its role in both personal and commercial context. We'll move to how insurance works in the next lecture. Till then, bye bye and stay safe.